Welcome to our training on correlation and private equity returns. This is a topic that is crucial of how the private equity market moves compared to the overall market. This video will help you to understand the correlation between private equity and other asset classes. Private equity is both an asset class and an investment strategy. Distinguishing between the private equity asset class and the private equity investment strategy can be confusing and creates challenges for the traditional approach to asset allocation. First, investment in private equity is illiquid, and the money is often tied up for 10 years or more. Secondly, the funds are often highly concentrated and involve significant company-specific risks. Third, private equity funds are not transparent, and there is frequently a lack of reliable, publicly available information. Fourth, and perhaps the most importantly, there is a wide dispersion between the top-performing funds and the rest of the pack. What exactly is a correlation between private equity and a public index? The question appears to be clear, but its meaning is less easily understood. Is it the correlation between a direct investments and the index, or between a private equity index and the public index? For example, a private equity investor cannot hold an index of private equity, but can only invest in several private equity funds, whereas public equity investors can hold the index. Thus, a correlation study between a constructed private equity index and a public index is not directly relevant to the investor, as the investor can only invest in a small part of the available private equity funds. But there are additional issues with correlation. First, returns on private equity funds are measured using the internal rate of return, the IRR, or multiple. Additionally, public market products use time-weighted return, TWR. Thus, they use two different return measures, which makes it meaningless to compute a correlation between the two time series. In theory, a volatility of private equity could be computed using the TWR, where the inputs are the quarterly reported net asset values, NAVs, plus the cash flows in between. As explained above, changes in the NAV are artificially low due to infrequent updates and the conservative valuation methods. Any correlation computation will therefore reveal a low relationship to public indices. Second, even in public markets, the study of correlation is viewed with suspicion. Correlation typically fluctuates substantially and changes dramatically with the period of sampling. Hence the saying, lies, volatilities, and correlation. Moreover, during a severe downturn or market crash, all asset classes become much more correlated. Third, there are two ways to approach the question of correlation, namely whether it is a correlation of the cash flows or overall return. However, the overall return, that is the fund's IRR or public market equivalent, PME, might be less correlated. A fund manager typically invests over the first 5 years and divests over the last years, and the returns between the two direct investments is less correlated when the first happens in year 1 and the second in year 5 than for the same year. This effect might become important and reduce the correlation with the stock market. An investor not only needs to look at the correlation to the public markets, but also at the correlation between different segments of private equity. Again, such a study is difficult to undertake because there are no real indices for each segment, such as public indices. Private indices do not exist that consider all drawdowns, distributions, and NAVs, but no investor can invest in this way. Therefore, investors should look at the correlation between returns of private equity funds and different investment foci. The question is, how correlated are the performances of funds that start in the same year with funds of the same market segment and funds of other markets? Venture capital funds that were raised in the mid-1990s posted returns in excess of the Russell 2000. It is interesting to note that funds raised in 1998 through 2002 produced internal rates of return that were materially lower than the public markets. In fact, the median venture capital fund has underperformed the Russell 2000 for most of the past decade. Buyout funds raised over the past decade have outperformed the Russell 2000 over the time period from 1995 to 2005. In recent years, fundraising for buyout funds skyrocketed. Meanwhile, the differential between median buyout funds and the Russell 2000 has been declining in the most recent years. But even without looking at empirical evidence, amount, and timing of distributions should be correlated to the stock markets. A boom in the stock market means better opportunities for successful IPOs and more cash in the pocket of trade buyers and higher valuations for companies. Several studies have looked at the relationship between exits and the stock market and have found significant correlations. The market conditions affect the decision to go public and the exit opportunity. To summarize, the distributions of a fund are clearly affected by the markets. Thus, investors should expect that when the stock markets go down, distributions will also dry up, though possibly with a time lag of a few months. Still, even if distributions dry up during a downturn, the value of the portfolio company might not have been lost but postponed with an exit a few years later. This realization leads to the question of whether the fund performance is less correlated because it is aggregated performance of 10 to 20 portfolio company investments spread over 10 years. The bad and good periods might cancel out each other to some extent. In general, the less correlated assets are within a portfolio, the lower the risk of the portfolio because low and high performances happen independently of each other and cancel out each other. Thus, if private equity were less correlated with other assets within a bigger portfolio, a greater capital allocation to private equity would make sense. Many of the early studies claim a low or moderate correlation, but their methods are flawed. These studies mainly use the two well-known private equity indices from Cambridge Associates and from Thomson Venture Economics, which create time series based on the drawdowns, distributions, and the NAV of the unrealized investments. And, as shown before, the volatility is artificially low, which leads to an artificially low correlation. Many institutions have increased their allocation of venture capital and private equity in the belief that the returns of these funds are largely uncorrelated with the public market. But there appears to be many linkages between the public and private equity market values. Thus, the stated returns of private equity funds may not accurately reflect the true evolution of value, and the correlations reported by venture economics and other industry observers may be deceptively low. To ignore the true correlation is fraught with potential dangers. However, many of the correlations from other alternative assets are lower than those experienced by private equity. The correlations may be understated due to the infrequency of reporting for private equity and the use of estimates in calculating private equity returns. Therefore, diversification should not be the sole reason to invest in private equity. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.